Dear students, this is a class for corporate financial environment, which is very relevant topic for the student of finance. So before moving for the corporate financial environment, it has been prudent enough to know about what is finance, and regarding this finance, that when we are talking about finance, it obviously deals with some monetary terms and all that. But the most important thing for the individual investors is that I am starting from the individual perspective, then we come to the collective perspective. From the individual perspective, savings refers to the difference between income and related expenditure. If an individual makes an expenditure equals to his income, in that circumstance, it is never been possible for the person to go for making any surplus, because the savings comes out of surplus. So if a person earns rupees 100 and makes an expenditure of rupees 100, there is no question of any surplus. But when a person sacrifices out of his expenditure, that means if a person earns an amount of rupees 100 but makes an expenditure to the tune of say 80 to 90 rupees, obviously the person concerned is going to have certain surplus. Now whatever the surplus he acquires or he generates, it is not that all this amount of surplus is being invested. Rather, based on the quality or the characteristics of the individual, the person generally makes some, that means what I mean to say here, that he makes his savings in the most systematic manner possible, so that it can be able to generate certain income. What I mean to say here, suppose the person saves rupees 20 and out of these 20 the person keeps rupees 10 for his own sake, and the rest of the amount of rupees 10 he wants to make some concrete investment plan so that it can be able to generate some more return, then the question of investment arises. Now when a person invests or he desires to make some investment, there are lots of investment avenues, but the investment avenues or mode of investment is dependent on the person's, because when you pronounce the word investment, another word that comes to our mind, that what are the risks that are being associated with. Because when there is an investment, it generally depends on the quantum of risk a person can be able to sustain. Now it depends on the risk-taking ability of the investor, because there are two types of risks are being there. One is called the systematic and unsystematic risk. But if you go for the nature of the individual in terms of risk, there are two types of investors are being there, who can be able to take more risk and the person who does not want to take any risk. So those who want to take more risks, they have been termed as the risk prone investor, and those who do not want to take any risk, that is, they are being termed as the risk averse investors. Generally, when a person invests, based on the risk taking ability, he channelizes the fund in different portfolios, because there are a number of, what I have already said, there are a number of investment avenues are being there. Suppose a person who is risk averse, obviously he will make that investment in certain avenues which can be able to generate a secured return, like in the case of banks fixed deposit or banks savings account, which can be able to generate a fixed amount of return. There are some other avenues are being there. Suppose post offices are being there, insurance plans are being there, putting money in some gold investment. So that is to some extent is less risky. But when a person invests in securities where lots of risks are being involved, in that circumstances, it also depends on the person's risk taking or risk absorbing capability. What I mean to say here, that there are in the stock market as well, there are different types of securities are also being there. And based on the, because in the stock market parlance, there are some blue chip companies are being there. The blue chip companies means those companies which have been termed as a consistent performer. Consistent performer in the sense that they can be able to generate consistently from the corporate entities point of view as well as from the point of view of the shareholders in terms of enhancing the price of the stock, in terms of as the company is a consistent performer in terms of providing profit or earning profit and sharing a part of the profit as dividend. So obviously it can have a common instinct of increasing the price of the shares in the market. So the stakeholders can have more credibility about the person of the about the corporate performance. So in certain circumstances, the stakeholders means the shareholders can be able to generate more income and become interested to put more money into the equity market of that particular company. But in the stock market parlance, the thing is that because if you go for the term, using the term awareness or the literacy about finance, the investors generally have lesser amount of the awareness about putting the right money to the right option so that it can be able to give the maximum amount of return. And it also depends that how the person is literate enough to put their money rightly into the right channel. Because in the stock market parlance, there is a common saying that don't put all your eggs in a single basket. What that means? Taking that risk perspective into consideration, that if a person puts all his money in a single stock, then what would happen? That if the particular stock suffers or the share of the particular company suffers or the company as a whole suffers, then the entire investment cannot be able to generate any income. But if that person can be able to put the money in the different portfolios, that means like if you put your money in, put your eggs in different baskets, if one basket falls and the egg gets destroyed, the other 9 or other baskets can be able to recover the loss of that particular loss which has fallen. So in that same circumstances, if a particular share, suppose if a person makes a portfolio of 10 different shares based on his ability to purchase, and if 1 or 2 stocks suffer any loss, the rest of the shares can be able to compensate the loss. In the stock market parlance, that is called hedging. Hedging means that how to protect oneself from that unsystematic risk. Because when you put your money in the stock market, there is some systematic risks are being there. But when you are but the unsystematic risks are very, very difficult to predict. So in that case, if a person can have the knowledge of, because there is a subject in your, I think in your course that is called security analysis and portfolio management. What it says that if you have a very good observer of the market, then there are lots of options are being there to put the money in different baskets. I am not talking about to put all your money in the shares, but rather in different basket means you can put some of your money in the debentures, you can put some of your money in the fixed deposit scheme, you can put some of your money in the gold, as well as you can be able to put some money in your stocks. So in that circumstances, so you can be able to generate a return. This is from the individual perspective. And individual literacy is very, very important. Literacy in every sense. If you say that if the political scenario is not good for a country or is not very consistent for a country, stock market cannot be able to perform as favorably as you trading. Because if there is a political unrest in that particular company or a particular country, automatically the country or the ruling party cannot be able to go for taking any concrete decision which is very much effective for the economic development of a country. So, understanding politics, understanding the climate, what I mean to say here, suppose if you are not aware of the rainfall for a particular seasons, what I mean to say, if there is a good amount of rainfall, what would happen? There will be good amount of production. For the manufacturing company's point of view, if there is right amount of production, automatically or more production, automatically it can be able to have the ability on the part of the manufacturing company to reduce their cost of production. And if there is a reduction in the cost of production, automatically the company can be able to generate some extraordinary income and can be able to go for making some better performance in the equity market. So, understanding the climate is also very, very important to go for making some investment decision. So, what I mean to say here that an individual before making an investment should have a better understanding and more importantly better literacy. So, if you are not being literate, so in that case it is not wise enough to keep belief on others saying and other recommendation to put your hard earned income and make some amount of loss. So, my suggestion to you that you should have sufficient knowledge. I am not recommending that put your money in the equity market, rather you must understand, you must, because another concept that has been coming out these days, that the government is talking about the term called financial inclusion. That means that you have to go for, because if you become educated, because a distance education program can have that ability to disseminate these kinds of information to large amount of students, so that you can be able to propagate your understanding of that particular subject to your other people of your region, so that you can be able to generate some more literacy. Financial literacy or financial inclusion can be able to have a very good impact in the overall economic development of a country. So, this is, if you go for this introduction about this particular corporate financial environment, so that is to be taken into consideration, because this is very, very important. So, today what I am saying that financial literacy is very, very important. So, if when you go for, because the subject is concerned about this finance, and if you are not aware of this system, like you are being a student, and if you are not aware of the total education system of a country, because in the case of this distance education mode, there are some students are being there, they are not getting the proper chance, opportunity or environment to go for the traditional system of learning. It may happen that you may be employed in some other places, but if you have a better educational knowledge base, having some post-graduation degrees and other degrees, it can be able to not only to acquire more knowledge, but to get certain more benefits from your own company, So, understanding of the system, like your education system, is very, very, very important, because if you go for the educational system, it is a complete set where the primary education, secondary education, tertiary education is the subset. Now, when you are an investor, when you are a student of finance, you must have the detail of this Indian financial system. As you are the resident, as the citizen of India, we should understand what our system says. Because if you do not have the system, understanding of the system, and if there is a debacle, there is a regulatory authorities are being there, and if you can be able to go for requesting to those regulatory authorities of your problems, they can be able to go for giving the guidelines. So, we will talk about this Indian financial system today. This is very, very important for a student of finance to understand what is the totality of the finance, of the financial system of a country. The Indian financial system is banked on two subsystems. One is called the financial system, which is being termed as structured system, which is very, very important. But there are certain ancillary system which comes out of the structured system, is called the informal system or unstructured system. In every circumstance, because it is the part of the corporate environment. If you go for the corporate financial environment, there are some good amount of companies are being there, which are very prominent. But there are some lesser known companies are there. But the good companies, the authorized companies, they come out with some certain rules and regulations. But there are certain companies are being there, like if you go for these market vendors, the vendors who are been selling their products in the local market, they are not been taken as registered, but they are been coming out of this informal system. Like in the case of the financial system, there is then formal system and informal system. Where the formal system, there are 5 different components are being there. First of all, because if you go for the Indian financial system, since this independence of our country, the system is been going on. But what has happened, that all the time, for promoting, for attracting more and more investors, more and more stringent rules and regulations, so that we can be able to reduce the unauthorized activities, we are going for making certain revisions all the time. Because after 1991, when there is a liberalization and globalization policy that has been implemented by our government, there is a paradigm shift in the total financial environment of our country. Because there are certain regulatory organizations are being set up, which can be able to go for protecting not only the interest of the investors, but the overall corporate entities at large. So, formal financial system is banked on 5 different components, starting from the regulators who are regulating the entire capital market, the financial market of our country. We have got the financial institutions. Financial institution means, because if you want to make some investment, obviously you need certain institution. Like if you want to study something, there is no institution at all, then where to study? Like in the case of this investment, there are some institutions which will help you to go for making that investment. There are some market concepts are also being there in the finance, because like in the case of the trading of the securities, like when you want to purchase something from the market, like we have got the vegetable market or commodity market, or there are gold markets are being there. In the same way, we have got some financial market where it exclusively deals with the securities. Next, when you go for purchasing or dealing with the securities, there is what I use the term securities, that means the instruments. There are certain instruments are also being there, because these instruments can help you to retain your investment. Because when you go for purchasing securities, there is a transaction between you and the other purchaser and the seller. You are the purchaser and the other person is the seller from where you have been purchasing. So, there is a exchange of certain instruments. You are exchanging your check, which is a negotiable instrument, and in exchange of that check or payment, you are getting some shares. And finally, there are certain services are being there, which are part of this total system. Because if these 5 different components, if one is missing, we cannot be able to go for completing the total financial system, because each and every one is being tied up with one another. Now, if you start with the unorganized system, because that is also part of the financial system. The recent episodes of these cheat funds, like the Sahara group of companies as well as other cheat funds that have been coming out, it is out of this unorganized financial system. Actually, those persons are been capitalizing the vacuum of this financial system. And we have got the experience that how many people are being under the trap of those unstructured systems. But in different villages, we generally have the different types of financial institutions in terms of money lenders, because the villagers generally do not have that requisite literacy, or for that reason they have to bank on the local people, like the money lenders. Local bankers are also being there, the small traders are also being there, landlords are being there, who are being generally been providing finance, not directly but indirectly. And this is the common phenomena in every part of the globe. We are not talking about India, we are not talking about West Bengal only, but it is totally different parts of the globe we are getting this unorganized financial system. Now, if we come to the each and every component of the formal system, because we are very much concerned about how the total Indian financial system is been behaving and been performing. And if you go for this total overall performance of the financial system, we will find that regulators are being there which play a very key part in regulating the total financial system of our country. If you go for the finance, the highest authority in terms of making decision or framing rules and regulations or policies, it is been the Ministry of Finance. The Ministry of Finance generally makes all these provisions and rules and regulations to have a very good control over the activities of the capital market or the financial market in a broad sense. The Ministry of Finance, along with, because there are a number of financial institutions, what I have said you repeatedly, the different types of institutions are being there, like for the purpose of controlling the banking operation, which is part of the total financial system, and it is one of the key components of the financial system. All types of banks, whether it is a public sector bank or a private sector bank, because the private sector banks are also been operating nowadays in India. So, all these banking operations are being regulated by the Reserve Bank of India. Like in the case of the capital market, it is being controlled, and the money market as well, it is being controlled by the Securities and Exchange Board of India. It is been